Good day and welcome to our third webinar regarding the amended Fit and Proper requirements. Today we are discussing the financial soundness requirements which were introduced by the amended Fit and Proper Board Notice 194 of 2017. The new Fit and Proper requirements have introduced some very important changes to the financial soundness requirements, especially to those FSPs that collect premiums or hold client funds, Cat 2, 2A, 3, 4, and also for those FSPs that have juristic representatives. The new financial soundness requirements apply to all FSPs and juristic representatives, but they do not apply to key individuals and representatives and an FSP who is registered bank as defined in Section 1 of the Banks Act, or a registered insurer as defined in Section 1 of the Short-Term Insurance Act, provided that the FSP meets the financial soundness requirements in those acts. The general financial soundness requirements for FSPs are as follows. First, all FSPs and its juristic representatives must at all times maintain adequate financial resources to carry out their activities and to meet its liabilities as they become due. Second, all FSPs must implement effective financial strategies and systems that will maintain and assess, on an ongoing basis, the financial resources required to cover risks the FSP may be exposed to, and the risk that the FSP or juristic rep may not be able to meet the financial soundness requirements. 3. In addition to the previous requirements that a FSP may not be an unrehabilitated insolvent or under liquidation or provisional liquidation, the new requirement further states that an FSP may not become or continue to operate if the last mentioned proceedings are pending, business rescue proceedings are pending, or if an FSP seriously and persistently failed or fails to manage its financial obligations. Now we are going to break down the new changes by looking at each specific category FSP. The assets of a Category 1 FSP that does not hold client assets or receive premiums, as well as a juristic representative of a Cat 1 FSP, must at all times exceed the liabilities of that FSP or that juristic representative. Although the requirements seem the same, the following fundamental changes implemented by the new board notice should be noted. First, the definitions of assets and liabilities no longer have any exclusions. Goodwill, intangible assets, and investments in or loans to related parties are no longer excluded from the definition of assets, and liabilities no longer exclude subordinated loans. Although this means that Cat 1s who do not hold client funds or receive premiums are now permitted to include loans to related parties in their assets for calculations of their solvency requirements, they are unfortunately also no longer permitted to exclude subordinated loans from the calculation of their liabilities, which may have a significant impact on a number of these Cat 1 FSPs. Second, juristic representatives of a Category 1 are also required to comply with solvency requirements from the 1st of March 2019. Let's have a look at the changes on other categories of FSPs. The new requirements have introduced significant changes which affect the following FSPs. Category 1 FSPs that hold client assets and collect premiums, a Category 2, 2A, 3 and 4 FSP, and a juristic representative of the above FSPs. The above FSPs must comply with the following requirements. The general solvency requirement, namely that assets must exceed liabilities at all times. Additional assets, working capital, and liquidity requirements. Reporting requirements regarding liquidity calculations and early warning reports. We wish to draw your attention on the amendment to certain definitions. All other definitions for the purpose of financial soundness calculations for Category 1 FSPs that hold client assets and collect premiums, a Category 2, 2A, 3 and 4 FSP, and the juristic representative of these FSPs remains the same as before, except for the following definitions: assets, annual expenditure, and liquid assets. Assets in relation to general solvency requirement and additional asset requirement means the assets of an FSP excluding goodwill, intangible assets, and investments in related parties. The board notice now also excludes loans to related parties from the definition of assets. Please remember that as per the previous slide, this does not apply to Category 1 FSPs who do not hold client funds or administer premiums. The definition of annual expenditure has been extended. Before the introduction of the new board notice, the definition was as follows: the latest financial statements of the FSP, or the budgeted expenditure as expressed in the budget, or financial accounts in the case of applicants commencing with business, less staff bonuses, employees and directors, partners or members' shares in profits, emoluments of directors, members, partners or sole proprietors, other appropriations of profits to the directors, members and partners, 50% of the commissions or fees paid to representatives for rendering of services that did not form part of their remuneration, depreciation, bad debts, and any loss resulting from the sale of assets. The new board notice removes the deduction of 50% of the commission or fees paid to representatives and replaces the deduction with the following: remuneration that is linked to percentage of the FSP's revenue or percentage of the revenue generated by an employee, representative or contractor of that FSP, and that in the absence of such revenue, the FSP has no obligation to pay the remuneration. The other permissible exclusions, for example bad debt and depreciation, remain unchanged. Previously, liquid assets were defined as cash and other assets equivalent to cash that can be liquidated without realizing a loss on liquidation, provided that A. 25% of such assets must be capable of being liquidated in 7 days, B. A further 25% of those assets must be capable of being liquidated in 30 days, and C. The remaining 50% of those assets must be capable of being liquidated in 60 days. The new definition includes 3 additional assets that qualify as liquid assets: a participatory interest in a money market portfolio, 70% of the market value of a participatory interest in a collective investment scheme, or 70% of the market value of a listed security. The conditions are also changed in that cash and a participatory interest in a money market portfolio must be able to be converted without penalty into cash, 50% thereof within 7 days and the remaining 50% within 30 days. Market value of a participatory interest in CIS and market value in a listed security must be able to be converted to cash within 7 days. The additional solvency requirements are as follows. Cat 2A and 3 FSPs are still required to comply with an additional asset requirement. These FSPs' assets must exceed their liabilities by 3 million rand. Cat 1s that hold client funds or administer premiums, 2, 2A, 3, and 4 are required to comply with the working capital requirements. Its current assets must exceed current liabilities. The liquidity requirements are as follows. Cat 1 liquid assets must be equal to or greater than 4 out of 52 weeks of annual expenditure. Cat 2 liquid assets must be equal to or greater than 8 out of 52 weeks of annual expenditure. Cat 2A liquid assets must be equal to or greater than 13 of 52 weeks of annual expenditure. Cat 3 liquid assets must be equal to or greater than 13 out of 52 weeks of annual expenditure. And Cat 4 liquid assets must be equal to or greater than 4 out of 52 weeks of annual expenditure. FSPs are required to prepare and submit the liquidity declaration to the FSCA. A Category 1 FSP that holds client assets or receives premiums and money in respect of a financial product, and a Category 4 FSP must submit Form A in Annexure 6 of the notice once a year with its financial statements. Category 2, 2A and 3 FSPs must submit to the Registrar Form A in Annexure 6 of the notice on a half-yearly basis calculated in terms of the FSP's financial year. The form must be submitted within 45 days after the half-year end. A juristic representative of a Category 2, 2A, 3 and 4 FSP must submit to its FSP Form A in Annexure 6 the liquidity declaration on a half-yearly basis calculated in terms of the representative's financial year. This form must be submitted 45 days after the half-year end. The concept of an early warning system has been introduced under the new requirements on financial soundness, which applies to both the FSP and any appointed juristic representative. Early warning requirements apply to all FSPs and the juristic representatives, excluding Category 1 FSPs that do not hold client assets or receive premiums or money. The FSP is required to notify the FSCA in writing in the following instances: when an FSP's or their juristic representative's assets or current assets exceeds their liabilities or current liabilities by less than 10%. In case of a Category 2A or 3 FSP, when the additional asset requirements exceeded the minimum requirements by less than 10%. The FSP or juristic representative does not meet any of the requirements in this chapter, or the FSP becomes aware of an event or situation that may or will result in the effect contemplated in this section. The notification referred to above must be certified by the Chief Executive Officer, controlling member, managing or general partner, or trustee of the FSP. If and when the above factors arise, the FSP may not directly or indirectly make any payment by way of a loan, advance, bonus, dividend, repayment of capital or loan, or any other payment or distribution of assets to any director, officer, partner, shareholder, related party or associate without the prior written approval of the registrar. This concludes our session on financial soundness requirements.